everyone, my name is Jason MacDonald. Today I'm going to talk about a couple of attractive looking trade ideas, one long, one short, within the same industry. That industry is apparel, clothing. This is what we call at the Institute tail risk trades. They're both with an approximately 6-month timeline, with the stories to play out during that time period. One is a recovery story that may well be now in the rearview mirror. The other one is a recovery stroke turnaround story which is yet to play out. So on to the long. Ticker VSCO, Victoria's Secret. Market cap $2 billion. Current share price $27.50. What do they do? Well, as probably many of you know, they're a lingerie specialty retailer selling bras, panties, lingerie, casual sleepwear, prestige fragrances and body care. Now, year to date, the stock price is essentially flat, but that doesn't tell us the whole story. There's actually been a lot of share price volatility, mainly downward volatility, to get the share price back to flat on the year. At the beginning of March, the company released its Q4 2023 earnings report, and on the back of that, the share price was hosed. That was principally down to weak forward guidance looking forward into 2024. As I said, the share price is now back to approximately the same level it was before that report, but in the interim, it fell 40% below those levels. In that report, the company downgraded their annual sales forecasts from $6.18 billion to $6 billion because of what they referred to as a softer North American market. Demand weakened in Q4 of 23 because of a challenged consumer and a shift towards e-commerce players like Amazon in conjunction with intense competition in the sports bar category from people like Lululemon. So for example, Victoria's sports bras were priced between $45 and $88, whilst Lululemon's were between $29 and $78. And as we know, consumers, given what's happened over the last 2 years with inflation, are now quite price sensitive. At the time, management indicated that the broader intimates market in North America would remain pressured throughout Q1 and Q2 of this year, but with sales trends improving throughout the second half of 2024. As a result, the share price was crushed. Let's fast forward to early May, when the share price reacted well to the preliminary Q1 earnings on the basis that Q1 wasn't as bad as had been previously guided in March. So it looked a bit like the management had previously kitchen sinked expectations, in other words, lowered expectations over dramatically. The stock price started to recover at this point. It then fell back after the actual results as opposed to the preliminary results were released. But the recovery proper in terms of the share price began in August after the company appointed a new CEO, Hilary Super, to start in September. This was the real beginning of the potential recovery story. Q2 earnings were released at the end of August. Q2 revenue of $1.42 billion beat the consensus estimates of $1.41 billion, and the EPS of 40 cents per share was above the market consensus of 36 cents per share. And at that point, the company said that they see full year 24 sales to be down approximately 1% compared to what they'd previously guided, which was low single digits. So this then fueled a further share price rally. So my question is this the beginning of the turnaround and a re-rating of the stock's valuation by the market? The trade thesis is based upon a new, experienced management team addressing in particular the North American market. We've already seen early signs of that happening. Since the CEO was replaced, more management changes have been announced. Ongoing earnings growth should start to lift sales and EPS numbers. So the long trade idea here is that the CEO's turnaround plan will help drive sales and margins higher. The new management operating plan is to make the brand more consumer focused and less driven by promotions, and that should boost profits and profit margins going forward. Time is needed for this new management operating plan to work. Hence, a long-dated, out-of-the-money call option structure is what I'm looking at, with a price target of $45 for the underlying share versus the current share price of $27.50. Now, in terms of context, the stock price was in the mid to high 40s at the beginning of 2023 and was even higher before then, so $45 is not an outrageous share price target. Specifically with respect to the options market, if I pay $2.20 per contract for 25 of the March 2025 33 strike calls, that's 20% out of the money, I end up spending $5,500. If the share price rallies to $45 by that time, I'll make almost 5 times, in other words, $24,500 on an outlay of $5,500. If the stock price goes higher, of course, the potential returns rise as well. This is a typical size trade for a trading account with $100,000 of capital. Clearly, different size trades apply to smaller or larger accounts. On to the short idea. Ticker ANF. Market cap $8 billion. Current share price $157. What do they do? Abercrombie Fitch is a specialty retailer of premium casual apparel for men, women and kids. They've got a network of over 700 stores in North America, Europe, Asia and the Middle East, and of course they've got e-commerce. They've got 3 geographical segments: the Americas, EMEA or Europe, the Middle East and Africa, and APAC, i.e. Asia Pacific. Within those segments, Abercrombie is about 51.4% of sales and Hollister is about 48.6%. So the question for me with ANF is, has that story basically got to the stage where it's as good as it gets? They're going to probably have around 65% EPS growth for this year, but this year obviously is almost finished. And the forecast for next year is a fairly paltry 3% increase in terms of EPS growth. Shares are up 80% year to date and 160% plus over the last 12 months. Over the past year, the sub-industry in the sector are up 33% and 36% respectively. So in other words, ANF has outperformed its sub-industry and its sector considerably. The last earnings report at the end of August was a good report. They surprised positively with sales by 4% and EPS by 17%. These were the comments which particularly interested me from the earnings conference call with analysts post the release of that report. So, sales growth has already started to slow. They mentioned that elevating operating costs on higher technology expenses and incentive-based compensation is something that they're experiencing. They referred to inflationary pressures being concerning, the quote being, "We continue to operate in an increasingly uncertain environment." They are experiencing competitive pressure, so it's still, as we know, a very competitive retail landscape. Even though inflation has dropped, a lot of consumers are still feeling the effects of 2 years of high inflation. A key input cost for the company is cotton. The cotton price has been trashed and looks like it may have formed a bottom, so has the cotton price seen its low? And also they mentioned that year on year in Q3, they envisage pressure in terms of freight. So the question that I'm asking is all of the above a sign of cracks appearing in the bull case for ANF? It's already 20% off its year highs. It peaked at the end of May. Short interest, in other words, the number of shares that have been borrowed to sell short, are near 52-week lows. So this is slightly a contrarian idea because there's no short out there really. Again, the same as with the long idea, time is needed for the trade to play out. Sales growth has already started to slow, but it will probably take 5 to 6 months for the bear story to fully play out. Hence, again, going for a long-dated strategy. And again, out of the money puts. So the idea here in terms of the trade would be a put options calendar spread. So that's where you're long a longer dated expiry than you are on the short side. So you're buying some options, i.e. puts, and you're selling some puts. The price target is $100 for the underlying shares by February of 2025, current share price being around $157. It was, for context, around $100 at the turn of this year. So, specifically in terms of how you'd put this trade on, if I pay $6.90 per contract for 10 of the February 2025 $125 strike puts, so in other words, again, 20% out of the money, I will end up spending $6,900. In addition to that, I can sell short 5 December $125 strike puts for $4.20 per contract, which would generate a credit of $2,100. So spend $6,900 on the February 125 puts and generate a credit of $2,100 by selling the December 125 strike puts, but we're doing it on a ratio. So we're buying 10 of the February puts and selling 5 of the December puts. If the share price remains above 125 until the December expiry, I'll collect that credit. If the stock then subsequently falls to, for example, 100, the February puts will make at least $18,000. Plus, I'll be able to generate a further credit after the December short options position has expired. That would mean an almost 5 times return on the initial outlay of $4,800. If the stock price goes below 100, obviously the potential return rises commensurately. On the other hand, if the share price drops quickly before the December expiry, so therefore the December options are also in the money, because this is a ratio trade, the overall P&L will still be positive, it just won't be anywhere near as positive as the first scenario. Again, this is a typical size trade for a trading account with $100,000 of capital. Both of these ideas involve no more than spending 5% of the overall portfolio. So in other words, not risking more than 5% in each case of the portfolio. If both ideas fail, it's a relatively small write-off in 6 months' time. If one of the ideas works, both trades are paid for and it's a good payout. If both work, happy days, it's massive returns. This is the type of trade idea that as mentors at ITPM, our students will place for a tail risk trade idea. If you'd like more information about our online education and one-to-one mentoring, please visit itpm.com. Thanks for watching.